Greetings, this is Jack Jones with Robare and Jones Wealth Management with our February monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right in. There's a lot to cover. First of all, I'll say it was great to see so many of you at our recent quarterly investment forum just a few weeks ago. In late January, we had over 100 clients at Perry's. We also heard from Finishing Touch Ministries and the good work that they're doing in our community. Quick note that our next quarterly investment forum will be April 24th. We also hope many of you will participate in our family love letter webinar on Thursday, March 21st at 11 a.m. This webinar is meant to explore critical conversations that are sensitive and are about preserving and transferring the legacy that you've worked very hard to accumulate and that you will one day leave behind. So we hope that you'll participate in that with us. Again, on Thursday, March 21st at 11 a.m. You've already received one notice about this, and we'll continue to send more. But if you have any questions about that or signing up to participate, please contact our office. So as it relates to markets, we did see by the end of January, the S&P hit at 4846, which is an all-time high. We actually have seen the S&P hit 5,000 for the first time ever. Even though it's drawn back a little bit from there, we are up so far this year. As it relates to election years, when January is positive versus negative, you'll see that the average return following January, the next 11 months in a presidential election year, if you get a positive January, up 12.7, a negative January, up 7.6. So overall good either way in an election year, going back almost 100 years, but definitely better overall if January was positive. The most recent jobs report had a higher than expected monthly job growth of 353, unemployment rate at 3.7, and average hourly pay on a 12-month basis up 4.5%. The surprise of the week came in CPI that was a little bit hotter than expected. 0.3 was what happened, 0.2 was what expected. So the year over year at 3.1 and core, which excludes food and energy, at 3.9. So a little bit hotter than expected. Markets traded off dramatically to the downside on Tuesday of this week. So that's something we're keeping a close attention to. And kind of what that means is, what are the odds that the Fed will cut and in what timing? I think the earlier percentage of these might have ticked up a little bit, but I still think you're looking at the back half of the year when, unless things change dramatically, you're looking at the Fed cutting rates. So the average length of time from the last hike to the first cut is 10.5 months. That would put us in the summer of 24 because the last rate hike was in July of 23. And if we look at the average one-year return on the bond side of the equation, 6 months after the last Fed hike, this is what core and short-term bonds and money markets have done. So if we apply that to this time frame, the last time the Fed raised rates was July of 23. So that puts 6 months after beginning January 26, so just past through January 25th of 25. Historically, those one-year periods of time after are pretty positive core short-term bonds and even money market accounts. As it relates to the economy, we're still expanding. This is the most recent Q4 print on GDP. Because the consumer drives most of the economy, roughly 70%, it's worth looking at how the consumer's doing, which we'll look at next. As it relates to the economy in 2024, it depends on who you ask, whether we're going to get the long-awaited recession. 84% of CEOs say that we will. Basically, the Fed staff is not predicting any probability of a recession this year. Consumers believe there's a 70% chance of a recession. So there's different cases. The bull case, which is the case for not a recession, is that consumer spending has kind of hung in there. The bear case scenario is that household debt has hit a record of 17 trillion, rising roughly 20% year over year. So the consumer is a little stretched, and we'll see that next. But if we do go through a recession, and what this looks at is 3 months before, during, and then 1 year and 3 year after. So really what this says is most of the stock market impact happens before a recession, that once we're right on top of a recession and during a recession, markets are kind of flat, but overall positive after, going back to 1929. And the consumer, this kind of looks at the consumer that drives the economy. And there's some things that are worth paying attention to here, which is the debt service ratio has gone up to just under 10% of disposable income is used to service debt. You'll see that this is a move significantly up for two reasons. Number one, the overall amount of debt, but also the cost of that debt with interest rates going up. And because of, in part, the cost of that debt, you'll see things like auto and credit card as of Q3 of 24, delinquencies are picking up. So you're in the 7.5% and 8% range of delinquency. So that's an important thing to watch in a consumer-driven economy. Also, this excess savings that kind of peaked during COVID is on its way to being burned off. So there's not that same cushion that there was here with a peak excess savings of 2.3 trillion. It's significantly lower now. So as we go forward into 2024, kind of some of the reasons for optimism are that we don't get a recession, so the soft landing is achieved. The Fed cuts rates, which overall is a tailwind for stocks. And market performance continues to widen. We've talked before about how 23 was driven by a very narrow band of tech stocks, and that continues to widen out. Now, there's also the case, of course, for pessimism, that we do go through a recession, the consumer weakens, Fed cuts interest rates, but not as often as expected, because maybe they get a surprise like this week on inflation. And there's obviously geopolitical risk that's kind of constant. We will have an election in 2024. I'm certain that it won't be any of the names that you see on this page, but how stocks perform in an election year is worth paying attention to. This goes back again almost 100 years at what on average markets do and by quarter. So the first couple of quarters, while positive, are kind of muted, a big third quarter and a positive fourth quarter. So this is kind of what to look for in an average election year. This year may not be an average election year, but this is what has happened historically going back almost 100 years. So we encourage you to contact us. None of this information talks to your specific circumstance. So please call us if you have any questions at all or want to schedule a meeting. We're here to serve you. So with that, we'll close. We hope to see you again in April or here in a meeting or a Zoom call with us in the very near future. Until we see you again, be well and take care.